All right, let's get into it. Today, we are talking about a huge shift that's happening right under our noses in the world of venture capital. People are calling it the 2026 harvest, and it could set off one of the biggest wealth transfers we've seen in a very long time.
Okay, so this quote, it really cuts right to the chase, doesn't it? While everyone's eyes are glued to the public stock market, there's this quiet revolution happening in the shadows. We're talking about those private billion-dollar companies, the famous unicorns, that could soon be on sale for pennies on the dollar. But the real question is, who gets to swoop in and buy them? And, more importantly, what's the catch?
And look, this right here is the perfect example. You're looking at WeWork. I mean, at its peak, this company was an absolute titan, valued at a mind-boggling $47 billion. But its collapse? Well, it's become the poster child for what happens when the hype train goes completely off the rails. It's what insiders call a zombie unicorn, a company that, it looks alive, but it's really just stumbling along, powered by the billions in cash it raised years ago. And trust me, it is far from the only one out there.
So how in the world did we get here? How did Silicon Valley manage to create a whole generation of these zombie companies? Well, to really get why this 2026 harvest is coming, we've got to take a walk through the unicorn graveyard and see exactly how it was built.
It all really started with this one incredibly powerful, almost seductive idea: blitzscaling. The strategy itself is kind of simple, but also pretty brutal. The goal is to grow as fast as humanly possible, just dominate your entire market, and then maybe worry about making money later. Think about Uber subsidizing every ride for years, or food delivery apps offering endless discounts. The point wasn't to build a profitable business from day one. It was to become the only game in town, even if you had to burn through billions of dollars of someone else's money to do it.
And for more than a decade, this whole strategy was basically strapped to a rocket. You see, after the 2008 financial crisis, interest rates were pushed down to near zero, which made money incredibly cheap and easy to get. This created what economists call a ZIRP environment, zero interest rate policy. Now, when safe investments like bonds pay you basically nothing, all that investor money has to go somewhere, right? So it floods into riskier stuff chasing higher returns. And that meant venture capitalists became, let's just say, a little less diligent, pouring billions into these blitzscaling companies and letting them burn cash for years and years without ever needing to turn a profit.
This timeline really shows you how the whole thing played out. First, you've got that long era of cheap money. Then boom, 2017 hits, and SoftBank rolls out its massive $100 billion vision fund. This just institutionalized blitzscaling, throwing such insane amounts of cash at startups that it completely distorted the market. But then, by 2019, WeWork's failed IPOs showed the first real cracks in the armor. So, fast forward to now, those zombies, they're finally running out of all that cash they raised. And that brings us to 2026, and what everyone is calling the wall of maturity. It's the point where hundreds of these companies have debt coming due, where their funding runway just ends, forcing them to either sell for cheap or go bankrupt.
Now, if any of this is starting to sound familiar, well, it should. We're seeing some pretty undeniable parallels to the dot-com bubble of the late 90s. Back then, the internet was a world-changing technology, and that was absolutely true. But that truth also fueled thousands of really shaky companies. You remember Pets.com, right? Firms with no real business model that just burned through investor cash before completely collapsing, leaving just a few giants like Amazon standing in the rubble.
And history might just be rhyming right now. Just look at this number. Projected spending on AI in 2026 is a staggering $2.52 trillion. To put that in perspective, that's more than the entire economy of Canada. Now, just like the internet, AI is a truly revolutionary technology, no question. But this massive gold rush raises the exact same question. How many of the companies getting all this money are building real, lasting businesses? And how many are just the Pets.com of our generation?
So, okay, we've got a graveyard full of these fallen unicorns. This is where we pivot. Because for a certain type of investor, a crisis is just another word for a sale. This is where the super disciplined world of value investing, the art of being a bargain hunter, slams right into the chaotic, hype-driven world of venture capital.
Let's just quickly compare the two ways you might get to own a piece of one of these companies. On one side, you've got the traditional IPO. This thing is a massive marketing event. Investment banks go on these roadshows trying to sell the company to the public at the absolute highest price possible. You're basically buying at the peak of the hype. But then, over on the other side, you've got these down rounds and secondary market sales. Here, you're buying into a distressed situation, often at a massive discount. It's not about hype at all. It's about trying to find a diamond in the rough.
And what's really changed is that this world isn't just for giant private equity firms anymore.
Platforms like EquityZen have popped up to create a sort of stock market, but for private companies. They connect early employees or investors who have shares and want to cash out with accredited investors who want to buy in. It's really the first time a gateway has been opened into what was previously a completely locked down, illiquid market.
But whenever a deal looks a little too good to be true, you have to start asking some tough questions. And that brings us to the most critical part of this entire explainer, the hidden catch. The thing that can turn a bargain into a total bust. It's the investor's secret weapon, or maybe their biggest vulnerability. So let's just ask it directly. What is the catch? You see a company that was once valued at $1 billion, and now you can buy in at a valuation of $100 million. It feels like a once-in-a-lifetime, no-brainer opportunity. But in the world of venture capital, the price you pay for the shares is only half the story. The other half is all about the kind of shares you're actually getting.
And the catch is hidden in this one critical term: liquidation preference. I want you to think of this as a golden get my money back first card. It's a contractual right that those powerful early investors, like the big VC firms, always insist on. It legally guarantees that if the company is ever sold, they get all of their original investment back before anyone else sees a single dollar. So this one clause, it creates this rigid, unchangeable hierarchy for who gets paid when a company gets sold, especially in a fire sale. Which means the most important question you can ask isn't what is this company worth, it's where am I in the line to get paid?
And this pecking order is absolutely crucial. It's known as the capital stack. Right at the very top, the first ones to get paid are the venture capitalists. They hold preferred stock with those powerful liquidation preferences. They took the early risks, so they get this protection. Now, once they've gotten all of their money back, whatever's left over might go to the founders and the employees holding what's called common stock. And at the very bottom of the stack, well, that's usually the later stage investors, the retail investors, buying that same common stock on those secondary markets. Yep, that's likely you. And here it is, the brutal truth. Let's imagine a company raised $200 million from VCs who have liquidation preferences. The company stumbles, and eventually it gets sold in a fire sale for, say, $50 million. Now you, the secondary investor, might think, great, the company sold for $50 million, my shares have to be worth something. But they're not, because the VC's contract gives them the right to the first $200 million. They take the entire $50 million from the sale, and the company's bank account hits zero. For you and everyone else at the bottom, your shares are literally worthless. And look, this isn't some hypothetical situation. This is exactly what happened with WeWork. This analysis shows that after the bankruptcy and all the restructuring, the public stockholders, the people at the bottom of the capital stack, were completely wiped out, gone. Their shares became essentially worthless paper. That is the real-world consequence of being last in line.
So as this great unicorn reset starts to happen, and all these fallen giants come up for sale at what look like incredible bargain prices, the ultimate takeaway here isn't just about finding a cheap stock. The real alpha, the real edge, might not be in picking the winning company, but in doing the hard work to understand the structure of the deal and simply knowing where you stand in line before you ever put a dollar in. Because in the 2026 harvest, that might be the only thing that matters.